Good afternoon. I'm Tyson Halsey. Income Growth Advisors is an investment firm I run. I also have a energy startup involved in the energy transition. And so I'm familiar with venture capital, private equity, and the public markets. I spoke yesterday. We have three great speakers who are going to talk about private equity today. We have Laurent Degryse, followed by Gary Post, and ending with Jack Isaacs. I'm going to quickly introduce everybody, but then I won't do justice to it. So I want each of those gentlemen to give 2 minutes to clean up my mess. And then we'll get into an overview of each of their respective entities and Q&A from there. So we're going to start with Laurent Degryse. I'll just do the quick bios. He's a partner at American Discovery Capital, and they're an independent merchant bank, so he's in private equity as well as in investment banking. We'll follow with Gary Post, who runs the K funds and a family office, and he invests equity capital across a range of industries, and end with Jack Isaacs, who has Empower Growth, and they're investing in smaller companies, primarily U.S. companies. I'm going to now talk a little bit about Laurent, give him some questions, he'll reintroduce himself. So my question, Laurent, am I saying that? Do you speak with, do you use your name with a French accent?
Perfect.
Laurent Degryse?
Exactly right.
Brilliant. Okay, so please describe how the private equity space has evolved since as a result of COVID and the shift in interest rates. I would say the flip side of the negative interest rate environment we had over the last decade.
Thank you. Yes, thank you for having me. Look, this is a very broad question. Certainly since COVID, there's been a massive impact on the private equity industry. And I think if you want to look at the macro picture, what has happened in the last 24 months or so is that, a large amount of capital have been raised in private equity, but it has been raised by a very much less number of firms. So what does that mean is that a lot of capital has been concentrated in fewer hands, and it's mostly larger funds that dominate the world of private equity nowadays. To give you a sense, for about $800 billion of capital that is being raised in a year, we used to have about 600 firms that were raising capital that same year. And now in the last 24 months, on a yearly basis, it's about 300 firms that are raising capital. So it's way less than before. So what does that do to the world of private equity is that you have very large asset allocators that have to deploy large amount of money into very few deals. And so there's a lot of competitions for the large buyout deals. At our firm, we have taken a very different approach. We are focused on the low middle market, which means companies that are, let's say, 5 million of EBITDA plus in the American market, and that are essentially business services tech enabled. So we're playing in the long trend of general digitalization of the economy. And we have focused on deals that are absolutely not in competitive processes. We don't participate in auction. We create our own deal flow, and we create relationship with individuals for whom we're probably the first in institutional capital. So it's a little bit different, and I think that in the large private equity environment that I was describing, you have to find a niche or a special way to play the private equity market.
Excellent. I'm going to move on to Gary Post, so we get a little bit of a introduction of everyone, and then we can have more interaction with the audience. Gary runs K funds. He also runs a family office, and Gary, why don't you try to answer the same question or some of the ones that we had discussed
Yeah, I'd like to
previously?
answer a different question.
Exactly,
Actually,
that's
I'd
what I was
like to
talking
talk
about.
about what private equity is.
Go
Now,
ahead.
if you're in Los Angeles, private equity means lower middle market buyouts. And actually, the scope of private equity is in three main dimensions. The first is venture capital. Venture capital is alive and well, and many firms are doing great. And one of the reasons they're doing great, they're typically sub $300, $400 million funds, and they're not on huge platforms that take up the Blackstone kind of people. It's a whole different ball game, and it's really where the growth of America is coming from. The middle ground is growth capital. We do growth capital at the K funds. We always have. We're representing families, including my own family. And we're looking for companies that are in the 10 million in revenue with proven unit economics, referenceable customers, and something that does things better. So, for example, our thesis is using information to do things better. And that can mean property management, and it can mean SpaceX. And we've invested in companies that look both of those, including SpaceX. So we're in the middle ground, no debt there for the most part. It's equity for companies that are growing. And a lot of the funds in our category are too small to be on broker-dealer platforms. And then we have the buyout firms. And the buyout firms range from niche firms up to the mega firms. Mega firms start to become closely allied with public equities. So when you're looking at returns and opportunities in the mega funds, they're tipping on to public equities. So you have these three parts of private equity. And before I miss this point, we have these things because back in the 1990s, the US government decided it would snuff out investment in technology firm by individuals. So it changed the trading laws such that broker-dealers like you, the famed four horsemen, like Hambrick and Quist and such, they were gone because they couldn't make any money. And what that did to the average investor, you could invest in Microsoft in 1983, but by the time 2003 rolled around, the value was being created in the private markets. That's why family offices gravitated to this, because they were missing out and annoyed that they were missing out on the great growth companies of America. So we're in this niche to help people get at it. And of course, the markets have a way of working themselves out such that there's dramatically great secondary markets in some of the private names, notably SpaceX. You can go into the market, if you know what you're doing, you could buy SpaceX today. So I'll stop there.
That sounds great. So we'll roll to Jack Isaacs. He's with Empower Growth Capital. They invest across the board. And what are you seeing in terms of the environment today, Jack?
Yeah. Let me give you a little
your company.
Yeah, a little bit of background. I came into private equity a little bit sideways. I was never an investment banker. I was a lawyer for about 15 years. I both litigated and did SEC filings, merger and acquisitions work, was in-house at a technology company, and then eventually matriculated to private equity. I started at Kane Anderson. I was a managing director and partner in that fund, and ultimately have now gone off on my own. I look at companies with between $5 and $15 million in recurring revenue, start talking to companies even earlier than that, just to get to know them, for them to get to know me. I invest between 5 and 15 million. I try to keep my numbers real simple. I think people that get MBAs are way too smart for their own good and overcomplicate things way too much. I try to keep things very basic. The industry as a whole has been pretty terrible. The last year and a half has been pretty miserable. And I think we've kind of seen other panels, including the venture capital group and then the mergers and acquisitions group, really talk about how challenging the markets have been And I keep raising, I have concerns about the amount of money that's flowing into a handful of very large funds as opposed to money going out a little more widely to more diverse groups, because I feel you have this kind of this clique of people that kind of create an echo chamber of how aren't we all wonderful because we all think this is great, and therefore prices kind of go up, but you're missing opportunities in the marketplace that I think are incredibly valuable. Also, Jordan here had mentioned, and I think it's really worth emphasizing, when people are pulling back, that's the time to be investing, because that's where really the opportunities are. When everyone's running at the opportunity, you're not going to get a nice return on that. But if people are pulling back, there's real opportunities out in the marketplace that you should be paying attention to. I do think in terms of the three different buckets that Gary was suggesting, I think those buckets are becoming less clear. I think groups from the lower end are moving up into the middle end, groups from the top end are moving down into the lower end. There seems to be this odd amalgamation where it's like, okay, I have a bucket of cash, let's figure out what to do with it, as opposed to people with very distinct and clear investment profiles. That's not necessarily great for institutional investors or family offices, because they want to be able to diversify their own investments, not have someone else take their money and invest it willy-nilly wherever they can figure out where to put some money. And so I do think there's a bit of a problem where you put some money into some of these larger billion-dollar funds. They're like, oh, great, now I can figure out where the hell I'm going to invest it. It's much easier for family offices in particular to kind of diversify their own risk by choosing specific industries or verticals or areas and how they want to spread around their risk. And I do think it's a little unfortunate that there isn't a little tightening up of focus in my space. I think that's enough.
That's great.
Send it back
So
to you.
Laurent, or Gary, what areas do you like in particular right now?
Oh, I'll grab that one because we're very well defined. In fact, we've focused more in the last 5 years on what we think is really a sweet spot of growth in America, which is companies, again, as I mentioned, that use information to do things better. The information revolution, market 20, 25 years ago, is continuing, and there's opportunity for improvement in all sorts of area in our economy. And so we're focusing on a bit more of people that are providing these solutions. It could be lower prescription drug prices, more effective property management. These are all information. SpaceX, we thought was a launch company. We were doing a favor by taking a look at it. We said, well, wait a second, this is a telecommunications company that could bring broadband in the native voice to 45% of the world's geography. So what we found is we kind of went away from consumer and focused more on information to do things better, and talk about the puck being at where the puck was going is AI is accelerating that, and AI is for real, and its major application initially successful, profitably, will be in the healthcare sector.
And most of your investment is in B2B?
Mostly, I'd say maybe 20, 30% are to consumer, like the prescription drug company that we got involved in. It was to consumer, like a Kroger is a major distribution. So whether you have insurance or not, it's 50%, 60% less than it was 5, 6 years ago when we first invested in this company.
Yeah, similarly, I mean, we, as I said, we focus on business services. So those are businesses that are, generally speaking, asset light and that have a pretty significant growth profile, very attractive growth profile. The IT sector, the healthcare sector are naturally sectors that have higher growth profile than others. And we tend to focus on those ones as well. And yes, B2B mostly. And again, I mean, for us, it's also a question of mostly operational excellence and not a question of financial engineering in as far as we are, as far as our intervention is concerned. And we put a lot of emphasis on that. We tend to have relatively concentrated funds with few investments, but on each of these investments, we spend a ton of time. We are focusing on these management like hawks. And when I say this, is we spend a lot of time with them. We tend to speak to them every day. We help them. We leverage our network to their benefit. We leverage our experience to their benefit. We leverage the breadth of our merchant banking model to the benefit of these companies, especially when, for example, they do have M&A acquisitions that they need to do. We take that over for them and let the management do what they do well. It's operate their company. So, I think B2B asset light, significant growth profile. It's something that we keep looking at.
I saw that Elon Musk came out with he has a company XAI, and I think that they just were raising about $6 billion. Could any of the three of you talk about how AI impacts your portfolio companies?
I'll jump in. I get really concerned in my industry when everyone keeps talking about, the subject of the moment. So for a while it was the metaverse and crypto, and we keep going through these phases where people won't stop talking about a specific subject. I think AI has tremendous potential, and I am very excited by it. But I can't go to a meeting where people won't stop talking about the damn thing, and I think people don't even know what the hell it is. I am looking at a company right now that uses AI. I think it's amazing, but unfortunately, the technology is incredibly expensive. It's going to be the Microsofts, it's going to be the Googles, it's going to be these billion-dollar companies that really can afford to make real inroads in this space. The types of companies I'm looking at, and quite frankly, I think all three of us are looking at, their ability to utilize it as efficiently and as effectively as these multi-billion-dollar companies is really going to be challenging. Yes, my companies will be able to utilize it, but it'll be a fraction of what Microsoft will be able to do with the damn thing. And so, yeah, I can play with it for a little while, but I'm not putting all my eggs in the AI basket at this moment.
Yeah, actually, Musk the other day in an interview at the Milken conference was asked, what was the importance of AI in SpaceX? Which you figure, hey, there's somebody who would use it as a company, and he said zero, and doesn't see any application in the near term. We've invested in AI companies, and it depends how you define AI. But I think, for example, an AI program that will help diagnose patients' sicknesses, that's here today. That makes sense, but it's going to be a while. We have talked to a company that says, we will help you private equity firms use AI. And we said, okay, two blokes from Stanford, and I said, okay, bring it on. Let's tell us what you got. They claim to say that they would be able to look at a data room and come back with a report on the data room. I said, okay, we'll let you try that. So it's a ways away, but it is coming.
Laurent?
Yeah, I'll echo what the other panelists had to say. I mean, it's the infancy. It's the beginning of a technology emerging with enormous potential, but not immediate applications for most people. And so beyond using ChatGPT to get inspiration on content creations, which is probably one of the first things that you can use AI as an individual and as a business owner, the applications will be slow to come.
Yeah. So I used AI to prepare for this panel. And I used 3 different programs. I had a human group over in India, and I had 2 different artificial intelligence, and had them in a bake-off. Okay, tell me about this, and this. Here's the questions I went and said, And the results of it was pretty similar, amazingly enough.
So let's take the flip side. If irrational exuberance is when everyone is in love with an area, and this may be problematic, then where are the areas that you see distress and value that you find intriguing? Are there any distressed assets today that you invest
Look,
in?
I think the robustness of the economy has been pretty surprising for everybody. And yes, we have seen headwinds in some sectors where, business has slowed down, but we have not seen a massive amount of distressed deals coming on the market. And, the resilience of the US economy and mid-sized companies has been absolutely extraordinary. So I think what has happened, and there's been less transactions. You've seen a lot of slower M&A activity. You have slower acquisition processes by private equity firms, and less exits as well. And so there's a number of reasons to that. The financial markets are playing a role in that. The level of the interest rates are certainly playing a role on that. But I think we have not seen a large amount of distressed deals coming to our plate.
Yeah, I guess going off Laurent, VC funding in LA was down, I believe it was 46% last year. When there's not funding at the earliest stage, it makes it harder for our groups, for private equity. Those companies that don't get the funding don't grow large enough for us to put money in. It becomes a challenge in our space. So I have concerns that the pipeline, it might not be so visible right now, but the next 8 months, 12 months, we might have some real problems finding companies that have been robust enough to really do well. The next technology opportunities are going to be more limited. I don't do distressed. I don't want to do distressed. I want to do healthy, fast-growing businesses. Well, right now it seems like much of the family office community, institutional investors, they don't want to put money into cash flow negative businesses. Well, if you're a fast-growing business, it's math. You're probably not going to be cash flow positive, or you might be break even, but it's going to be challenging. If you're growing 100% a year, you're going to be in the negative just because the numbers work out that way. You're just growing a little too fast. And to get a family office to write you a check when, there are a couple $1 million in, burning cash, it is making, people used to use the rule of 40, which should allow for some ability to have negative net profit. You have family offices that are afraid to put out money to these fast-growing businesses if they're not cash flow positive. And I think that's a mistake. I mean, I think if companies are growing fast enough and they have a good customer base, you want to be looking at opportunities that where the companies are burning some cash because they're doing the right things if they're growing that quickly.
We're good with negative cash flow. We're good with it for fast-growing companies. But the critical element for us, which we're really focused in on, is unit economics. Is that extra dollar sales actually making any money? And particularly when software is concerned, is that R&D budget, is that really R&D, or is some of that R&D actually going towards maintenance of an existing product, which is a terrible situation?
So I have a question, Tyson, I'm just gonna ask it. So I think the problem with distress is we kind of were like saying, okay, great, COVID hit, it's gonna be distressed times, there's gonna be a ton of distress out there. Was that in 2009, there were only like 5 distress funds that had more than $1 billion, and now there's 20. And I think a couple like maybe BlackRock or Blackstone has a distress fund that's $40 billion. So you would never see it because all the distress deals would go first to those guys. And that's like an example of a paradigm shift, really, in what you used to see, right? Can you guys talk about the paradigm shifts that have happened in private equity now and like what's different operating in this environment from 10 years ago? Because because a lot of people have the idea of investing like they got 10 years ago when it was a distressed period or interest rates were higher. What's different?
Look, I mean, certainly the first element that I talked about at the beginning of the conference was the shift towards very large funds, as you just implied. That is certainly a huge difference compared to before. Nevertheless, there is still a large segment of the middle America that needs to be served with access to capital and access to expertise to grow to the next level. So we are trying to respond to that question. I think that has always existed. There's always been a new generation of fund managers that were happy to roll up their sleeves and do the hard work of working with a smaller company that is not as structured as larger corporations that have a more seasoned management suite. So that has not changed. I think in the near past, what has changed is the inflation and the interest rate environment that has had an impact certainly on the level of debt that you can put on a business at acquisition. That has had an impact on the fact that banks are not good providers of debt for companies that have not a level of equity that is beyond $5-6 million of EBITDA. And so for the lower market, it has been extremely difficult or expensive to have access to debt when you do your acquisition. That has changed dramatically. We have observed in the last 24 months that there is a delay between the effect that these higher interest rates should have on valuations and the expectations from business owners when they want to negotiate a deal with you.
That's the paradigm shift also, right?
Yeah.
The whole difference in perspective towards valuation, it's incredible.
Because if you look at
Miles apart.
If you look at multiples on EBITDA, they reached a peak in 2019.
There you go.
They have slightly gone down to today, but not in the proportion that reflects the lack of access to debt for certain level of companies, and not in the proportion of the impact that it has on an IRR if you take into consideration higher interest rate payments and lower turn on EBITDA in terms of debt to EBITDA.
Yeah. I think the biggest area the biggest paradigm shift is Marty and I, we've been doing this a long time. I've been doing this for 20 years now almost. It used to be GE credit, like that's where everyone was trained there, everyone started there. GE credit shut down. Everyone who was trained there started their own shops. There's now 1 billion lenders out in the marketplace, which was great when interest rates were low. When interest rates went through the roof, suddenly kind of things changed a bit. It is a very competitive marketplace, and a lot of private equity has moved to the credit side because they think they make more money on the credit side. Why take as much risk when you can be first in line in terms of a liquidation? So the whole market kind of has shifted pretty dramatically very recently. I think a lot of people are kind of getting the bends because there's been a lot of changes. And that being said, there's a lot of companies that aren't really credit worthy. And so they're really more equity. They should be equity investments. So you have a lot of companies that are kind of missing investment opportunities because there's a hell of a lot of credit funds, but they're not really credit risk worthy. And so, equity is riskier, but there's more opportunity and more upside. So it's a tough time right now, I think, in the marketplace for small businesses. And it's quite frankly a tough time for private equity and credit markets.
So your colleague Frank McMahon did a thoughtful analysis of what happens at higher interest rates. So we've had lots of LBOs at this level of interest rates historically. And so what I would be looking for is these macro demographics of baby boomers selling their businesses. And what are they going to do? Wait 5 years for the interest rates to maybe go down? And we don't know if they're ever going down because we have other powerful macroeconomic forces saying they got to be high and they got to stay high. So if you're a boomer, you're worried about taxation on wealth and capital gains taxation. Well, I think you're headed for the exits, and you may accept a little bit less money, but I think that these are going to get done. Anytime you have a rapid change in a market, you have often a market freeze where buyer and seller can't get together. And, you know, these people that own, as Pat was saying, all these businesses in America, a lot of children aren't going into these businesses. They just aren't going. They don't want to have anything to do with it. And so they'll get sold at 7% interest rates rather than 3% interest rates. And so I think that the momentum will pick up after the market kind of reaches a new equilibrium.
And just as a follow-on to the comment that Laurent made, we've seen a really bad strategy from a lot of healthcare companies that came to us in the last 2 years, all trying, instead of doing price rounds, they're in the growth stage, right? They've been looking for, to offer some kind of a debt instrument, right? A convertible note or something like that at a Series B. And you're like, well, no, and those deals have all been rejected. And 95% of the time they're being rejected. People want the down round, and I harks back to what Tyson's talking about also, that people have resisted repricing. And now they're just going, a lot of them are going out of business.
Yeah, and we're seeing that repricing in what we're doing. And I think one of the elements we're talking about, what are you looking for now? I think that the people in the growth category, as we are looking more for, okay, where does that cash flow start? And is there enough money to get there? What's the downside? How many years of runway do you have? And I think if you go back, as Marty, you were saying, go back 10, 12 years ago, it was growth at all costs.
Yep.
And so if you had a 300% annual compound growth rate, you could count on getting more money, and you can't do that in today's environment.
Absolutely. I agree.
Question. What do you all think about, the topic here is private equity outlook, but a lot of these private equity firms are going from just equity towards credit funds and sort of, I guess, more safe, but less going all in type of approaches and being actively involved. How does that affect your outlook and deal sourcing or consortium building?
I think there's a contradiction in our space where, again, more and more money is going to fewer and fewer funds. At the same token, I have an ongoing bet with a friend who keeps saying, there's going to be a real reduction in the number of private equity groups because there's not going to be enough money to go around to these private equity groups, not going to be able to raise money. And my comment to him is the one area that you're guaranteed growth is private equity, because exponentially, historically, they continue to grow. You've got these young people who go to these large firms, they get trained how to do it, and they go, you know what? Why is all the money going to the top guys? I'm going to start my own fund. And so there's a ton of groups out there, maybe too many. And I do think one of the ways they're dealing with the challenges is that, I'll be flexible. I'll go into credit. And so I do think you are seeing a lot of private equity groups that are really private credit groups. They say they're private equity, but it's really debt with warrants. It's not really a private equity as a way to kind of try to get money to do the funding. I think that's really where a lot of people in my industry are going.
Yeah, and I think that point illustrates also an issue where people now are probably difficulties of finding the right deal flow. And so the issue is I've always, I was running a family office back in the days, and I've always laughed at the presentation of private equity where you have this slide with the big funnel. And they show you the top of the funnel, and they proudly tell you that they have looked at 3,000 deals this year. So how is that possible? You don't look at 3,000 deals.
AI.
And so
We're looking at it.
Look, I think the reality is that if you look at all the books that are coming from brokers and investment banks, you can probably look at 3,000 deals, but only a fraction of that applies to you as a firm. And so our view is that you have to find a system, a method that gives you access to the deals that you're likely to do. And if you do that systematically, you will not have to veer towards different strategies to deploy the capital that you've been given. And so that's what we've been focusing on.
I'm way more bullish on smaller firms. Why is a lot of money going to big firms? Not because they're big. It's because they're on platforms that can be distributed by massive broker dealers. And you can't put a $400 million firm up on Morgan Stanley. Just not possible.
That's a good point.
Well, I mean, also there's marketing channels and they also control the marketing channels, but.
Okay.
Can I ask another question? Because Rob calling me to just ask the last question associated with one of the great turnaround artists in the United States, right? And do you think that there will be opportunities for turnaround private equity in the near future? Because I mean, people were able really to get as much leverage as they needed to stay alive. And I think, you know, now encumbered firms may need that, you know, because there was a turnaround market 15 years ago, it was pretty robust, right? Yeah, your thoughts on turnaround private equity style business?
Hell yeah.
Bring it on.
Yeah, I mean, I think it's coming. I mean, I think companies have held on for a very long time without the influx of cash, without the influx of capital. And I think we are going to have some very good, decent companies that are going to go under that are going to really need some help. And so bankruptcy lawyers are not as active as they will be. At least that's my prediction.
Could you guys talk about geopolitical trends? There is discussion of reshoring after a period of offshoring a lot of manufacturing and American business over to China. And now we have problems with Russia and Ukraine. And are these driving positive trends towards your businesses across the board in the US?
Look, as far as we are concerned, we're focusing on business services. And so that doesn't really impact what we're doing. And if it does, it's really on the margin. So I don't have a specific view that, you know, would be helpful for you guys in terms of an impact on private equity operation.
We're just not in that kind of manufacturing businesses. I don't know. I can't comment on
it. Technology doesn't necessarily come from the US. And so India has been forever a huge source of body shops, but also the technology. The IIT schools in India are just the best in the world. China used to be, is a great source of intellectual capacity, but with the tensions that are rising, there is a need to find other locations. There was a company I was looking at in Ukraine before the war broke out. One of the key programmers died in the war. Do I think things are going to come back to the US? No, I don't. We're too expensive here. I think there are too many other places around the world that have great schools, great engineers, great programs that can do a lot of the work less expensively than what we can do here.
So what countries do you like? For example, India, Japan, Argentina?
Yeah, exactly. I mean, actually, all of those, or even just, we talked about manufacturing, just going across the border to Mexico. I mean, a lot of Mexico City, there's opportunities there. Anything in our time zone is certainly helpful. So going down South America, there's opportunities down there. But Eastern Europe, there's tremendous talent in Eastern Europe. That really has not been tapped into as much as it should be. That's my take on it.
Thank you, Marty.
You got about 10 minutes.
I was giving that 10 minutes to you.
Oh,
The
okay.
audience.
I'm gonna add Vietnam and Nigeria. And Philippines, right?
I was just talking to a company out of Ireland that was using Armenia. I was like, wow, that's really interesting. Why aren't you using Ireland? Yeah, Romania. I've got companies that are using folks out of Romania. And boy, oh boy, some of the engineers there are just brilliant. So there's definitely a lot of folks overseas that can do a lot of the work that we can do here, but they're cheaper.
What are the best sectors to be in that aren't the sectors that you're in? What do you like the most that you're not doing?
That we're not doing?
Yeah.
I think we're doing what I'm not sure what we're missing out on
Okay.
at the moment. If I knew, somebody maybe could tell me, but we're not aware of sectors, oh, we'd like to do this, or we would like to do that, but we can't figure a way in. So I don't think that's, and the
So what
question.
are some of the recent deals that you have?
Well, they're again, with the thematic of let's use information to do things better. And they can be in insurance and prescription drug distribution, can be in fintech, making small insurance policies more profitable by outsourcing them to a company that can specialize that. Sounds like a little problem, but there's huge number of policies across the nation. They're like $15,000 in value. So that's a point solution. And things that we would like to be in maybe is where are the point solutions with AI that will develop? We don't want to be in the large language model category. That's a big player. We're offered, hey, why don't you we can get you into Musk's new AI company. And other than the name of the company, there's pretty much nothing we could know about it with like a $5 or $7 billion. So, hey, we're fiduciaries here, we can't go with that storyline. So I think that is, we'd like to do more in healthcare information, healthcare AI. We're doing some, we'd like to do a lot more.
Yeah, same here. Healthcare. I think if you want a precise usage, we would love to find a good company that does patient recruiting, optimization, and patient management on behalf of medical practices. I think that's an area that a lot of improvement can happen. It is critical for large platforms that have a brand across multiple states, such as orthodontology, dentistry, all these sorts of our large multi-state service providers. The other thing that we like a lot is technologies and services that work around the grid optimization. We are looking at some. It's very difficult to find the right one, but it's definitely something that would be an improvement on our services.
So I partially own a concierge medical practice, and I think that the concierge space is greatly underdeployed because there's not a lot of concierge doctors in the specialist space, like for oncology, where actually there's a lot of need for continuing care.
We're in a couple of companies like that.
Right.
We love the space. And the reason we love the space is we can track the price of a Super Bowl ticket at $10,000 means there's a lot of people out there with money that can afford to have the best services. And they're going to pay for them. And as the population ages a bit, it's kind of, well, you could invest in that house in Hawaii, or you can maybe buy 5 years of great healthy living to spend with your grandchildren. That's a pretty easy decision when it's positioned in that way. So we're in both a longevity concierge business and a urgent care concierge business, and we agree with you.
Well, so the standard of care about an oncology is that if you're a cancer survivor, you typically go back to your general practitioner to take care of you, whereas what you really need is monthly, quarterly checkups with your oncologist, right? And so and if oncologists were concierge, it makes it far more easy to deliver that product. And the people who the concierge networks that exist right now take a heavy premium. So if you knew how to market into the space.
Yeah.
At a much cheaper rate, you could probably build up a client base pretty quickly. So, so what other industries do you think are ripe for change? Because healthcare is like kind of like the blob, and you guys like saying, okay, great, we can deconstruct the blob.
Yeah.
What other blob-like?
Insurance.
Insurance, okay.
Insurance, not necessarily the underwriting, but the sales and processing.
Is there a regulatory aspect to insurance, which maybe?
Yeah, there's some regulatory aspects on pricing, which busts up the market for a while because insurance companies, for example, in California, like State Farm, left the state and said, we're not underwriting any more policies here because the Department of Insurance won't give us rates that allow us to even break even. So we're done here. And it actually spawned a group of kind of competing companies that weren't regulated in the same way.
I would want to, I would want to say, to be clear, the healthcare space has pockets that can be very lucrative, but as a whole, it can be a quagmire.
Yeah.
There's a tremendous amount of regulation that is often changing. It can be very complex. The doctors themselves can be very challenging. There's a whole slew of issues that you need to be cognizant of before dipping your toe in.
Look at the medical records business, right? There was 30 or 40 startups, a few survived, and none of them have made lots of money, right? So,
Yeah.
What are your thoughts on in terms of industries that are ripe?
Yeah, I mean, look, healthcare for me is still a great center of interest. We played it was an angle in our second fund. We made an investment in a staffing company that staffed people in IT for healthcare for the healthcare industry. It's a large company based out of Chicago. They're very, very good people, strongly managed. We are very pleased with the investment. We did that investment in co-investment with Francisco Partners, and so far it's been a great success.
Yeah.
I think a couple of you all are.
I'm sorry, I misspoke. We did that co-investment with MSouth out of Atlanta. Sorry.
A couple or maybe all three of you all are here in Southern California. Combining a little bit AI, but more so on private equity on entertainment. And I guess one of the big things going on right now is this Paramount or the position of the Redstone family.
Yeah.
And interesting enough, that was initially started off between one family office to the other, from Ellison's son to Redstone's daughter, right?
Yeah.
And then
Now it looks like Sony.
Well, now you've got that.
Yeah.
Now you've got Apollo partnered with Sony.
Yeah.
On this. Recently, there's been a lot of on AI and entertainment where they've been, went on strike. Is this an entertainment, which hasn't been mentioned, but it's around here? Do you think that deal is going to be there going to be a lot of suitors of that? Do you think prices can go higher than what is it, 26 billion?
I don't think there's been an industry that's done more to hurt themselves than the entertainment industry. I mean, if you look at kind of just the cable networks and how they've splintered off and how they seem to be almost intentionally shooting themselves in the foot, just in terms of marketing themselves. HBO, no, now it's Max. Like, what the hell is Max? I mean, your Paramount, which has what is Paramount Plus? You have all of these pluses. People are expected to pay for the cable, but they're also expected to sign up for every single damn. I mean, and then the way they're releasing movies. How many damn Marvel pictures can we watch? Anybody can watch. It just feels like this town is the center of the entertainment capital of the world, and I'm proud of that. I'm thrilled that we're here. But boy, oh boy, they really just seem to keep messing themselves up in ways that I find incredibly frustrating.
It's uninvestable from our standpoint.
I think we're looking at it differently. I think we're living in a moment where there's an extraordinary race for content creation. there's a demand, and there's so many platforms that can, display and play that content. I think there was a first wave of anything is good, we'll put it out. I think there is a little bit more of a search for quality right now. And so you see a little bit less of, explosion of new titles and series and blogs and stuff that come on the platforms. We believe that trend of demand for a lot of content in very different categories will continue, and we are trying to play this by a different angle. We have made an investment in a company that is doing payroll processing for the entertainment industry. And so it's a software company that provides a software to help production company do budgeting effectively, and then process the payroll and calculate the residuals and all that over time. So this is a kind of side investment in that race for content. And obviously, the more content there is, the more their services is needed, then the more they make money.
Picks and shovels.
Yeah. One of the things I would say about the entertainment industry that I think is worth noting, and I think everyone knows this, but I just want to mention it. It is our soft power. It is America's soft power. It is the way we promote ourselves and advertise ourselves. It's the way we promote democracy, promote equality, by having us as the entertainment center of the world. We are promoting America in a way that I don't think most people recognize or pay attention to. But our movies, our TV shows, they're broadcast everywhere. And it's actually really important that we continue to kind of play a big role in sending out America's message to the rest of the world.
How do you invest in it, though?
Can't.
Okay.
I think entertainment industry, especially the movie industry, is gonna be under amazing attack from AI in the next 5 to 10 years. Because one of the things that the movie industry wants to do is always control their content. They want to create action figures. I mean, they blew it with Star Wars and Jar Jar Binks. Those are the right age, you want to remember that. But now you can create entirely AI realistic movies about any actors.
Yeah.
Right? I mean, and not only that, but I mean, you could probably go through every script in Hollywood in AI in 10 minutes.
Yeah.
Right? Because the AI is so powerful and able to just go through these large language models and just go through everything that's published.
Yeah.
Right? So it's really going to be a big challenge for the industry. I'm not sure, NYU students will be generating their own movies with AI in 5 years. So it seems to be a big challenge for Hollywood.
Yeah, Agreed. And it won't just be coming from the US.
Yes, right. Anybody with a perspective. So I just want to, ask this last question about, so it's Kane Capital. We worked with Kane they've had many people present to our group over the years, and 5 or 6 years ago, they said, one of the reasons for our success is that we look outside of where everybody else is looking. We'll go to great college towns with great managers who are underfunded, and we look to give them growth capital. Do you think that there's strategies does that strategy still work? Do you think there's strategies like that are, underdeployed in your response?
Yeah, I like that strategy. Lots of good stuff happening in Tulsa. And it can get into the community a lot earlier or a lot easier. And I think for that strategy, has worked very, very well.
I agree with that. And I was trained at Kane Anderson. I grew up at Kane Anderson. Fargo. I mean, I was there in February, oh Christ. There's lots of places around the country that are developing really interesting technology, really interesting products and services that if you just stay in LA and New York and San Francisco, you're missing out on real opportunities.
Yeah.
Agreed. Yeah.
Any other contrarian strategies you think might work in this day and age? I mean, outside of your great strategy you already have, or?
Commodities, energy, do those make sense? Space?
Well, those are really, asset heavy, investments, and it's more for the largest private equity funds.
No, it's brilliant for Kane Anderson. I mean, the energy sector is probably the most successful sector. They have a whole group down in Houston that are the best and the brightest. They have, PhDs in, that field. I can't compete in that area.
Yeah.
I don't want to. Yeah.
I like pro sports and there's a whole strategy to it, so I'll discuss offline.
Good others.
But I do want to mention that I am working with a group of independent doctors and who are all looking about whether they should sell out to, it's probably like 1,500 doctors, whether they should sell out to private equity, there's all these roll-ups going on or not. And then also the value of becoming concierge. So if any of you guys want to address them, it might be worthwhile. We're having just like a video Zoom conference in the end of June to discuss the strategy.
Mhm.
It's the pluses and minuses of PE, because I think a lot of doctors think they're gonna still maintain their individuality to make decisions, and I think some of that goes away when you start dealing with private equity. That's a safe thing to say.
Yes.
Well, you're gonna lose it when you sell to a large healthcare operator, strategic also.
Right, you sell the hospital, right, so you have to, it's the best of make the best of bad decisions, right? So anyways, great job, guys, really fantastic.